Hello, team. My name is Ashley Shepard, and today I'll be leading this training session on conducting a sensitivity analysis as a tool for capital budgeting. Financial management is really about how an organization makes decisions that impact its long-term growth and sustainability. The main goal is to maximize shareholder wealth, basically to make sure the company's money is being used wisely and profitably. The three main functions are investment decisions, like which projects to pursue, financing decisions, how to pay for those projects, and dividend decisions, how to distribute profits. In my HR and Army background, I've seen how good financial management isn't just about numbers. It's about discipline, strategy, and using resources efficiently. That mindset translates perfectly into capital budgeting, where we decide which long-term projects are worth the risk. A sensitivity analysis is basically a what-if tool. It lets us change key assumptions like sales volume, material costs, or interest rates to see how sensitive a project's results are to those changes. For example, if projected sales drop by 10%, what happens to the project's net present value? This helps us see how much risk we're really taking on. I like this approach because it encourages proactive thinking, just like in military planning, where we prepare for different scenarios before making a move. The quantitative side of sensitivity analysis involves running the numbers. We start by defining the base case, our best estimate for cash flows, costs, and discount rates. Then we change one variable at a time to see how it affects metrics like net present value or internal rate of return. The goal is to identify which factors have the most influence. If a small change in sales volume causes a big drop in NPV, that's a red flag. This method gives leadership the data they need to make more confident decisions. While numbers are critical, qualitative factors often determine whether a project succeeds or fails. Management skill, team performance, and organizational readiness all matter. External factors like market trends, technology shifts, or competitor actions can make or break a project, even if it looks good on paper. I personally believe that ethics and sustainability should also be a part of every sensitivity analysis. A project that harms the environment or employee morale may cost more in the long run than it earns financially. Internally, companies use several financial methods to manage risk and capital budgeting. The risk-adjusted discount rate is one common method. It increases the discount rate for riskier projects to reduce their present value. We can also adjust cash flow projections to reflect uncertainty or run simulations to test multiple scenarios at once. From a leadership standpoint, regular reviews and audits make sure assumptions stay realistic and that projects align with strategic goals. Externally, organizations have to monitor factors beyond their control, like inflation, interest rates, and political or economic instability. Comparing performance with industry benchmarks can help identify gaps or threats. For example, if supply chain partners are struggling financially, that's a risk that needs to be built into the project's assumptions. Understanding the external environment is just as important as analyzing the internal numbers. To summarize, sensitivity analysis helps leaders integrate both data and intuition. It's not about predicting the future, it's about preparing for it. By combining financial data with real-world factors, we create decisions that are more resilient, strategic, and ethical. I think that's the real power of financial management, helping organizations take smart risks, not reckless ones. Here are the sources I used for this presentation. These authors really highlight how financial management and capital budgeting are more than just accounting. They're strategic tools for building a sustainable and profitable future. Thank you, and I hope you've enjoyed this presentation.